Good morning and welcome to the Monday Call brought to you by NZ Funds. I am Stefan Clark, Chief Client Officer at the firm. The spectacle of the US election, mounting government budget pressures, persistent inflation concerns in key economies, global power shifts and new technologies are driving a complex and opportunity-rich environment for investors with longer time horizons. This morning we explore the shifting environment with London-based James Grigor, partner at Syzygy Investment Advisory and also an NZ Funds alumnus. Syzygy is a global macro asset manager that serves sovereign wealth funds and family offices around the world and is one of a select group of managers with which NZ Funds partners. Hi James, it's great to have you here, and I'm also joined by Mark Brooks, Chief Investment Officer at NZ Funds, to have this conversation.
Morning, everyone.
Morning or evening, Stefan, Mark. Great to catch up. Looking forward to having a chat, learning lots, and not talking too much about some things, and talking a lot about really exciting things like the Test match clean sweep in India and things like that.
Hey, let's crack in with some finance-related things, even though the cricket is always tempting. In the States, there have been some changes over the last few days. Trump has obviously been elected, and that has led to some changes in market positioning for investors. Tell us about how you think about what his election means for financial markets in the US, and maybe we start with the Fed and interest rates.
Sure. So, Mark and I have been through a couple of elections together, standing side by side, and we always had a game plan. And I remember, I think Mark was at 2020. We had a game plan that if certain things would happen, we would do A, and if other things would happen, we'd do B. And we ended up doing B, but for the totally opposite reasons why we were going to do B in the first place. And I think that in the end, elections are wholly uncertain. And I'll take a step back. I personally, this is just a personal opinion, don't think it's overly surprising at all. I think there was one wayward poll in about Iowa a couple of days ago that gave one side a reason to be positive, but it was pretty clear from all the polling that this was within margin of error, but this was a pretty high chance. And then if you look at betting markets, and maybe betting markets reflect a truer sense of people who think about these things, although a lot of US citizens can't actually bet in betting markets, but they were very, very favorable of a Trump win. And so I think in some ways it's really interesting and concerning depending on what side you come down on and your views about global politics. But from an investment perspective, going into the election, there's always a tendency to de-risk or increase your exposure or do something with an anticipation that something's going to happen. And I've learned the hard way that actually, you know what, whatever your long-term view is, hold that. And you have contingency plans if something really bad happened. I don't know, a repeat of January 6th or something might cause big volatility. But in essence, I think I'm talking to the converted here, but I think you just almost ignore it. But
I think there was sorry to interrupt, but there was an interesting piece by one of our other managers, Fisher Investments, that made the point that 40% of the market is strongly viewed one way, 40% of the market is strongly of the view the other way. Going into election, they're both uncertain. At the end of an election, one of those 40% are happy, and the uncertainty's gone. So by definition, you have uncertainty coming in, and by definition, you have more certainty on the other side. So that is generally a positive for markets.
And that's exactly, it's like we planned this, Mark. That's exactly the point I was going to make. If you look at the volatility index and the move index, which is Mark can explain it better than me, but the volatility of the interest rate or bond market, they've both come substantially down since the election. And it's not trying to make a call on what market's going to do. It's just less uncertain. And now that the Feds just came out and talked about what they're going to do with interest rates, then volatility comes down again because the less uncertainty there is, the less volatility. And so then what does that mean for markets in the short term? Well, probably it's quite a good period of time, and I think that's what you're seeing. You're seeing some really good moves in equity markets. I think we can talk about the bond market in a second, because I think that reflects probably more longer term potential policy decisions. But from an equity market perspective, it's a great time. And then, you could even think about people who do position and sort of don't heed the advice of, none who cares about what I say, but heed the general advice of don't do anything rash prior to an election. Well, it seemed like there's a lot of risk taken off equities prior to the election, and there was people were sort of sitting underweight, whatever that means, and therefore they're sitting there going, well, I probably need to get back reinvested now, because not because they have a view of Trump versus Harris, but more that point that Mark makes, that the uncertainty's gone, the volatility's down, and markets are probably pretty happy with that, so you need to get back invested, and that's going to be self-fulfilling prophecy, and markets go up on the back of it. So I think whatever your political persuasions are, a decisive win in the short term is really good and great for markets, and we've seen that, and we see some good moves, and it's kind of like wood election as we hit record highs.
And I think most of that fits with history, right? As long as the economy has not been in recession, generally post-election, it has a positive experience. As you say, people sort of de-risk going into it, and we did see a decent amount of that. I think, especially in the US, you saw sort of people selling into the highs and taking off gross positions. Now they're adding them back, as you touched on.
I guess people hold off making capital investments. They hold off doing selling houses in New Zealand. I just think about in the lead up to the New Zealand election, the number of people here who I knew personally who are, I'm just going to wait to see what the outcome is, as if it will change what their ultimate decision is going to be. But once the certainty's gone, then at that point they're ready to go again.
Yeah, I think that you do get some elections like the UK where there is quite, despite the Labour government, but the Labour Party sort of denying it will happen. But it was obvious that if they got in, there was going to be quite a significant change around certain aspects of the market or the economy, whether that's tax or inheritance tax or things like that. You didn't know where, but you sort of knew that would be a change. But again, what do you do about that as a long-term investor? Because if you're a short-term investor, you shouldn't be invested in equities anyway, probably. I mean, short-term meaning really short-term. And if you're a long-term investor, what are you really going to reposition your equity portfolio because of a potential for something potentially happening maybe one day?
Obviously we now have the certainty. Markets have responded positively, and we've had the people are now exploring the question about what it means day to day. And one of the most common sort of areas is the US's role in the world, and also tariffs and the extent to which Trump is going to implement tariffs, and what that means for the US economy and consumers, and also what that means for economies outside of the US, such as New Zealand, that exports into it. How do you think about that? And there's still some uncertainty there, but it's clear there's a direction.
I think this is where you get more into personal or opinion around what a Trump presidency looks like. And I think it does have big implications of what happens with certain aspects of the economy, trade, interest rates. Even the Fed came out and said that they wouldn't be hesitant in raising rates if they needed to next year. And I guess setting out the two schools of thought, it depends if we want to talk about it from a BBC perspective and not give a view, or of a CNN or Fox News perspective and give a really heavy view on an opinion. But from the BBC view from the start, on one hand, it's Trump says all these things to be really popular from a news media, Twitter point of view, gets his name out there, causes headlines, but actually when it comes down to it, and when he becomes president, which he is, a lot of that is all talk, and actually there might be some changes around the edges. Don't forget the tariffs he brought in last time Biden didn't take off, so there's a lot of tariffs still sitting there. But some of the discussion he's made about lots of different things, whether it's tariffs, whether it's Ukraine, whether it's tax cuts, whether it's massive increase in spending, you know, things around socio-economic relief, immigration, abortion rights, all those things. On the other hand, and so be much more sort of normal meaning sort of status quo kind of presidency. And with that comes, I guess, things aren't as bad as expected. You know, there might be some things to save face, but actually from a New Zealand point of view, as an export nation, you know, doesn't really affect it. And you can start to justify some of those opinions. So Trump loves strongmen, and he loves President Xi and from China, and really admires him and the way that he rules his country, and they kind of have a bit of a rapport. If you remember last time they caught up, if you see some footage of it, there was an actual relationship there. And so perhaps he needs to do a few things on one hand, and President Xi needs to retaliate to save face, but actually it's fine. On the other hand, this is a president that has the Senate and most likely the House. This is someone that is all about the deal, and someone that has 4 years left and doesn't have to run again, and loves to leave a legacy, or would love to leave a legacy, and has also been discussing quite aggressive policy, and saying, and has been, as far as he's concerned, which is, you know, was a decisive victory, has been given the mandate to implement it, and might feel very, very empowered to. And I think, I'm sure you've talked about this before, so this is nothing new, but the key difference between Trump 2024 and Trump 2016 is he's ready to go. Last time when he won the presidency, he kind of didn't even know he was going to win it, and he was really, really quite surprised. And it took, if you remember, it took a long time to get anything in place. First thing he did was fire his transition team, and it was it sort of took 2 years for the people like Bannon and those guys to come in and start, you know, implementing policy that perhaps some people were a little bit concerned by. Now he's had 4 years to think about it, 4 years to plan, and he's done it before, so he knows the inner workings of being in the White House. And so things could happen quite fast, and I think that you might, you know, there's a potential to see some of these changes around tariffs, around deals around Ukraine, and some of his big promises around immigration. For example, even if you are a spouse in the US, married to a US citizen, and are trying to get extend your green card, they've just shut up shop. They're not taking, because they've got an influx. They've got such a long list of people to get through, because they think that from January 6th, is it? 20th? Forget the day he actually becomes
20th
president.
or 26th.
20th, yeah. That it kind of shuts down all ability to get visas. Now that, you know, these are just rumors and that sort of thing, but it could happen really fast. And so I think that so that's the BBC. There's on one, this could happen on one side and be business as usual, or it could be quite an aggressive presidency. He's got form and bringing in some of these controversial policies, and he's had a lot of time to think about and get ready for it. And I guess the jury's out which way he'll go. You know, we can go into it in more detail, but I think what that does mean is, while the short term is positive, I think what it does mean in the longer term is you'll get volatility as we have to go through it, and that provides some uncertainty, also lots of opportunity. But but it also makes for a market that is a little bit wary, and that's why I think, and again, Mark, this is your specialty especially, but is why probably 10-year bonds, are taking a bit of a slugging as interest rates go up, because there is a bit of uncertainty around a few things.
And I think, to sort of echo your point, that speed could be interesting, because I think given the tightness of both the Senate and the House, even though they are Republican, in the early days you'd expect them to toe the line and follow the party policy. But as time goes on, you would expect that there'll be plenty of people, Republicans, who may get maybe more of the smaller government rather than larger government ilk, and go down the Musk path or something like that rather than more spending, vice versa. And even one of the interesting ones, I think, is a lot of the likes of the green spending under the Inflation Reduction Act from Biden has actually gone to Texas, a very red state. So whether they push back and what, how much the House and the Senate toe the line or not toe the line is important, I think, for me.
Because I guess they have to worry less. They have to worry less about Trump going forward. They always had to look after him, but as you get to elections, he's gone soon. You're already starting the next US.
It'd be working out who's next. Yeah.
But I think that Mark brings up a really good point, and I think some people aren't really, or what I can see, aren't talking about it. And I think it's hugely important. And this is a counter consensus view, and I think it's something has a really high probability of happening, is that he came in and the market's reacting because tax cuts and high government spending is inflationary. But I think there is a massive chance, and the way that you can have evidence that this might happen is look at the two potential Treasury secretaries that he might bring in. Scott Bessent, hedge fund manager for Key Square, and John Paulson, who some of our investors your investors rather at NZ Funds have had the experience of investing with in the past, if they've been with NZ Funds Wild. They're kind of the 1 and 2 in the horse race to be Treasury Secretary. Now it can be anyone, maybe it's Elon Musk for all we know. But if you read, there's some great articles even today in the FT around interviewing those two, and their mandate. And now it comes down to Trump, but Trump must be talking to them for a reason. But their mandate is cutting the deficit. It's not more spending. It is absolutely hucking out that deficit and getting it down and making a smaller government, as Mark was saying. And that's totally opposite from what a lot of the market is expecting around increase in spending. And what are they going to cut? Because in the US, there's not actually that much you can cut other than Social Security, healthcare, and defense. The rest of it is, look at the infrastructure spending. There is not much spent in the first place. And so I think you could get a real a different trajectory in a Trump presidency than everybody's expecting. And maybe the debt burden is so high that it's needed, but boy, that would decimate growth, and or would it with tax cuts? But it would decimate, I guess, some parts of the market.
Well, I think again that's one of the interesting points is from in terms of the numbers and from what we see, the US economy is robust and doing well. But putting into the mix, you've still got a government that's running a 7% of GDP deficit. That's a big number, and that's definitely, as you say, that's a driver of growth. Once you take out the parts of the economy that Wall Street are, the big tech, you do sort of question whether Main Street, and hence why the voters voted this way, is whether Main Street is actually in more of a recession or closer to recession than actually the numbers give it credit for. So if you have the government start to put the foot on the brake, as has happened here, you can see some quite quick shifts in activity.
I guess it does come back to, last time the tariffs supported onshoring and bringing, driving employment growth locally, and then tax cuts drove more investment and, again, bringing capital home in the States, which through Trump's last presidency seemed to have a meaningful impact at pushing at least markets higher and unemployment down until COVID kicked in. It will be interesting.
New Zealand does have a big decision here, and it was a bipartisan paper of ex-Prime Minister and a leader, Don Brash and Helen Clark, that came out with it. They are really against New Zealand, I guess, swinging towards the US and coming close to the US and away from its relationship with China. And you could argue the toss either way. But Helen Clark just commented, sort of doubling down on that paper that her and Don Brash wrote around, and it was just this morning, I think I saw it pop up on LinkedIn, saying you have to accept what's happened in the US election, absolutely, and the people have spoken, and it was decisive. But it's going to be a volatile government, probably. He either wants to break it and rebuild it to make it better, in his view, that's volatile, or he's going to just leave it and you've got a 7% deficit and things are a little bit tight. And does New Zealand really want to tack towards that and tack away from our biggest trading partner, China, and really annoy them and put all our eggs in that US basket? And probably from a security point of view, again, this is just laying it out. I'm not smart enough to know these things, but from a security point of view, yeah, perhaps you do. But from a trade point of view, if you're about to get tariffs thrown at you, you probably want to stick with China and not the US. And that's really hard for, I don't envy the New Zealand government's decision around it, because the world's a dangerous place at the moment, so you want that security. But boy, if the US put tariffs on trade and we get wrapped up in it, and we've turned our back on China, and so they get annoyed and don't want to trade as much, yeah, that's painful. Look what happened.
I guess stepping back, it is true that there's a risk that Main Street is having a harder time, but right now in the States, growth is good. And so for our investors and thinking about long-term portfolios, and America's a place you want to be. That's where there's so much new productivity, there's so much technology, wealth creation. There's obviously the job numbers on the whole are really good. It's GDP is heading in the right direction. It's on the whole, it's a place you want to be.
Yeah, it's a place where you want to have your capital. Yeah, I think there's definitely two road economy, but you're finding that across the world, given capital versus incomes. Capital's gone up, incomes haven't. Those sorts of things, that inequality discussion. But yeah, I mean, the Labour government in the UK came out with all these growth measures so they could get GDP to 1.7%. It's like, is that it? That's 10-year plan is a 1.7% GDP number, and that's supposedly good. And the US is growing. What's GDP in the US? Over 3.
Q3 was 2.8%. But what we often mistake, I think our industry makes, is we talk in real terms, and that's 2.8% real.
Yeah.
Yeah, you add on 2% inflation, that's a 5% nominal growth rate. That's a good number.
Absolutely. And if you own equities which participate in that 5% number.
And earn a margin over that typically. Yeah.
Yeah.
Okay, one of the things Syzygy puts a bit of energy into is China, and understanding the role China's economy and the challenges it's facing and its role in trade. Take us through how you think about China and its trajectory, the challenges it faces. Obviously, it's got property problems, but it's also got some really good things happening. What are your clients asking and doing, and where to next now that there's its major trading partner is heading in a different direction?
I think that China is a super interesting market. One, their share market before a few months ago was down in the doldrums, and there was an expectation by the market that they needed a huge amounts of money pumped into the economy, and they've done it before, and the market was waiting for them to do it again, and then everything would be okay. And it was our view that they don't really want to just pump an exorbitant amount of money into the economy and hope that it works. And earlier on in this year, there were very clear signs from high up within the party and in the Chinese government that they were going to be very, very specific with the type of measures that they put in place to not just get the economy out of a short-term hole, but to really change the way they fix some of the issues that are making it lag. And so what does that mean? It's really try not to be the ambulance at the bottom of the hill. It's trying to be, stop things falling off the cliff in the first place. And I guess initially the market was really disappointed in that view because it was pricing in, they'll come out, they'll pump a whole lot of money in, and then things will be okay. And so it took a while to get going. But actually now that a few months hence, the share market is incredibly volatile, but the share market is incredibly cheap, and the government is absolutely committed to sorting out the problems once and for all. And we could probably talk for the next 4 hours about what all those problems are, but I think one of the biggest talked about one is property, and it's super interesting. It's property and just investing into the economy. And there's a few stats that, when you think about it, and if you then put it in the context of New Zealand, it's just so different, and you can kind of understand why they're doing it. So 85% of government spending in China comes from local government, not central government. Now, yeah, you could argue that's kind of all the same, but you could kind of argue that everywhere. So if you imagine 85% of all the services you get in New Zealand is from the local council, not the government, which is just not the case in Western economies. And then this highlights the issue of what's happening. So 85% of a local government's budget used to be spent on investing. Investing means housing, infrastructure, roading, rail, all that good stuff. So not services, not running the city, like spending on infrastructure. Now, 85% of a local government budget is spent on the services that it provides, wages for its people, but most importantly, interest rate, debt, paying interest on the debt that it has outstanding. And only 15% has been spent on investment. And that's the issue. You've had this huge amount of money spent on investment, which has now been spent on managing debt. And so the government is basically looking at ways to sort that out. Now, it doesn't want to just go in and bail it out, because if you bail it out and, you just sort of, I guess, restart the problem, and that's what they want to avoid. They want to sort it out once and for all. But they're being very specific about how they do it. And they're doing it a lot like what's happened in the US after the global financial crisis. It's sort of like the US TARP, which, Mark, I actually forgot what TARP stood for. We said it so much, but but it's basically
Troubled Asset Relief Program.
That's
the one, yeah. And it's effectively government guaranteeing debt, and in China they sort of call it whitelisting. So basically, most local government debt in China is actually sort of non-official, and they borrow this money unofficially for really, really high interest rates to build stuff, to meet targets, to get their city growing because they've got some targets, and I guess they get paid to do that. And so they borrow almost. It's hard to say if it's illegal, but it's not true. It's not sanctioned by the central government, and therefore it's unsecured by the government, and therefore the interest rates are really high. And what the Chinese government are doing basically is going, okay, all that sort of unofficial debt, we will sort of legitimize it. And what they're effectively saying, they're not paying it back for them, but what they're effectively saying is actually it is kind of government guaranteed now, and therefore the interest rates are a lot lower, so that's bringing down the interest burden on local government. So that's just like one tiny policy. So that's in the China of old would have just paid all the debt off, and then the local governments would have, I guess, just spent a whole lot of money up to their debt limit again, and we repeated the cycle. But instead, they're putting procedures in place to help and encourage, the proper prudent management of the balance sheets of local government. And so you've got this aspect of it actually being quite good. The second part, there's been announcements of some of the stimulus that is happening to do with this whitelisting and those sorts of things. And there's disappointment, but actually why it was disappointment is they're only allowed to, the central bank is only allowed, and Ministry of Finance is only allowed to spend money that's in the budget. Otherwise, they have to go to President Xi and get it signed off. And so they've only got budget signed off to the end of 2024. So the amount of stimulus, and I had a number, but it's 400 billion or something, 400 billion RMB. And people were really disappointed because that wasn't huge amounts of money to sort of completely sort out local government issues. But actually, when you draw down on it, actually that just needs to be spent in 2 months, because that takes you to the end of 24, and then it will start again, and there'll be a whole nother stimulus package put in the budget for 2025. And so, again, like I said, we could talk about this for 4 hours, but what I'm trying to say is that they are working systematically through the issues. They're trying to sort out the problem rather than just at the start before it happens again. And it's creating a lot more positivity. And then you can overlay all the positivity around China. The amount of savings that the consumers have just sitting in banks doing nothing. The amount of retail investors' ownership of the stock market in China is something like 3% or something of their portfolios. I mean, if that went to 5%, it would be trillions going back into the Chinese stock market. You've got housing market slowly being sorted out, and yes, it will take some time, but as the government helps to complete the unfinished houses, that's positive for both growth, because you've got construction, but also houses finishing, cities moving, things like that. So we're really positive. And the share market, the most important thing, the share market's cheap. And so it's a real opportunity, but it's volatile. And so I'm not suggesting you sell your big chunk of all your US equities, because it might be a little bit volatile and a bit more expensive now, and go and put it all in Chinese equities. But I think it's certainly an area where I would be looking at, and you can get exposure from just market exposure and shares there, and I think then the other way to do it is find a few themes or companies that look super interesting that will take advantage of that recovery in local government spending, which leads on to the consumer and spending their money, and things like Didi and things like that, which are sitting on a heap of cash, great companies, and when the consumer starts spending, they'll absolutely skyrocket. So we're really positive about China, and then some of the read across from that to other commodities, because in the end, China is 50% of the world's consumption of stuff, and if they start picking back up, that's really good for certain parts of the market, especially some commodities.
Australia is obviously one of the major benefactors of that.
I mean, the lucky country where have a whole lot of brown gold sitting in areas where people don't want to live. That's correlated to the biggest and fastest, one of the fast growing economies in the world. Is they benefit. I guess that's why they're in budget surplus, or almost.
And they still have inflation concerns.
Yeah.
Unlike much of the world. Hey, just before we move on from China, that their companies are moving up the value chain. And you've got businesses like BYD taking on Tesla. You've got chip makers now coming through. Obviously, their phone manufacturers are taking on Apple and Samsung, and a whole range of fronts. They seem to be making really significant inroads. How do you think about that from an broader China investment perspective? Does it underpin the thesis, or is it just still so at the margin in the broader economy?
No, I think it. Think about all the, there's Amazon and Alibaba, there's Facebook and WeChat. They want their pillars of success as well, and that's not necessarily a bad thing for investors, because it means there's other companies to invest in, and so you're not just reliant on a China property boom to sort of drive shares higher. There's lots of different sectors and industries that do well. A really good example of this is AI. Like, for countries like China, energy is a strategic advantage. So AI is turned sovereign. So countries don't think they can grow now without some form of AI, because it helps productivity. So it's really important. But what do you need for AI? In general, you need data processing. And what do you need for data process? You need electricity. And their ability, if you look at the UK and the New Zealand, their ability to build one power station to fix security of supply. I think in the meantime, China's building 50 nuclear power stations in the next 3 years or something like that. So their strategic advantage around energy and the ability to build it, like resource consents and things, the ability to power it with either fossil fuels, which, we can talk about climate, but, they still will, but more importantly with nuclear, and then to have it there gives them such an advantage. And they also have a huge amount of the raw materials to do these things. And so China is, put tariffs on them at your peril, because yes, you might not lose out as much on the importing cheap goods, because I think that trade's sort of over for the world a bit, because China's getting a bit more expensive. But there's a whole lot of other stuff that you could benefit from, that they will have a real strategic advantage, and I think that's why it's really easy to go, I don't want to invest in China because of it's uncertain or unknown. But I think it could be a big market, it is a big market that you'll be missing out on if you're not there.
You mentioned commodities. Gold has been on quite a journey of late. How are your clients using that as a hedge against inflation and or invested in it? And how does Syzygy think about that, and particularly in recent times?
Yes and no. Gold is a store of value, and it can be an inflation hedge, and that's you need the fundamentals you need the macro environment to benefit a commodity or any asset, but gold needs can be a good store of value and do well to protect your value in an inflationary environment. But you also need some fundamentals behind it as well. And what the interesting thing about gold is there is just a massive lack of physical supply. And when the macro environment's right, people buy gold. But how do they buy it? They buy the gold ETF. And what does the gold ETF do when someone buys it? It needs to buy that equivalent in physical gold. And there's a real lack of supply of physical gold. And so when it buys it, the price goes up because, simple supply and demand. And that self-fulfilling sort of dynamic has been really, really driving the gold price up. And what's causing people to buy in the first place? Yeah, probably a store of value, but there is a bit of a momentum trade there too, as people buy it. More physical needs to be bought, which puts the price up, which people buy it. So that's definitely momentum. So it's a mixture of three. It's macro, it's momentum, and there's a genuine supply and demand aspect to it, which is interesting. But it's been I mean, it's been a great asset class this year, and it's been a great diversifier. But it's one of those, it's an asset that doesn't compound its earnings over time. And again, it should be a part of your portfolio, but nowhere near the amount of your growth portfolio's equities. And everybody knows who know me knows I like taking positions in commodities, but it shouldn't sort of be the driver of a portfolio, your equities. And the same goes for all those commodities. But when they do have the right environment, they can be a fantastic way to generate returns. And this is why you invest them. Often when commodities are going up, it's an environment where equities aren't doing well. And that's absolute nirvana, because you can still generate returns without needing to worry about the equity market, which is bubbling along or going down or being a bit uncertain.
Yeah, and I think that's the key point, right? Commodities are always a supply and demand discussion. And it's about, where is that demand coming from, be it, industrial demand, be it investment demand, be it other issues, and where is the supply coming from? And as you say, gold is really hard to supply. It's really hard to create the price incentive to build a new mine. And likewise, even some of the substitutes, for want of a better word, are even more challenging. Something like silver. Silver is a byproduct of most mines, so there's very few silver mines in the world. So in order to increase supply, you have to have exponentially high prices at different points.
And then the lag from, when the price incentive is there to actually production is so long often too.
Like copper's the same, and you go, well, copper's a pretty common product, but it takes 10 years from let's build a copper mine there to extract it. And in the meantime, the amount of demand for copper is going up astronomically. I think 1 gigawatt of power demands 50,000 tons of copper, and so it's 1 gigawatt of energy generation demands 25,000 or something tons of copper. And China are going to build 8 gigawatts this year. I mean, like, where is it all going to come from? Now, the market seems to sort itself out mostly, this isn't when NZ funds have talked about super cycles before. This isn't a sort of a 1 or 2 year flash in the pan, because it can be sorted out quickly because you can build some more stuff. This is a super cycle, means it lasts quite a long time, I think.
Now, you've been in the UK, for 18 months now or something around that. And obviously quite a lot's happened. You've had a few different leaders locally, and the relationship with Europe is evolving. What are your observations around the direction of the UK and its economic growth story? You touched on 1.7% earlier on. And I guess your take on Europe and where that's heading. Are there growing green shoots? We often read about Europe sort of starting to improve, but having local information. Tell us what's your take on it.
I'll try not to get on my soapbox.
This is your moment, Tat. You have the soapbox, so go for it.
I have the soapbox, yeah. If anybody's still listening after my dreary answers in the previous 50 minutes. I think UK and Europe is... and why it worries me is because it worries me about New Zealand a bit. And you have this... The problem you have in the UK, and it's Europe-wide, but in the UK, the problem you have is government spending is going up dramatically. And the main reason it's going up, there was this big jump from COVID, and absolutely, and some of that needs to be rationalized and brought back. But you've got two aspects of the UK economy that most of the money's going on, and they're correlated: pensions and the NHS. The NHS is totally broken, and the reason why it's broken is is, yes, it could do with some more money, but there is a lot of more money from both Conservatives and Labour going into that. There is a lot of money being invested. But the issue is, as the population ages, there's just more stuff that people need doing. And this isn't me talking. This was an ex civil servant who was high up in the Ministry of Health or NHS talking, when he says that society needs to make a call that, is it right to provide on the government, on the taxpayer, the level of treatment that we're providing people, especially when and this is I'm not trying to be ageist, but especially when they're quite old or near the end of their life. And that is a call that society wants to make. Now, if my grandma, could have been helped, you'd want that money spent. But it's not just one condition now, it's 7 conditions, and the cost per patient is going exponential in the amount of money that they need to spend and the amount of time they stay in hospital. And that's just going to get worse because the population is getting older. And so you've got an NHS that is really inefficient. You can sort out efficiencies, but it's really inefficient and needs its efficiencies sorted out, as well as the fact that there's just a whole lot more people that need treatment and a whole lot more treatments per person. And then you've got the pensions, where normally how society works is that the generation who are working pays for the pensions of the people that are retired. That just, you sort of pay one forward. No problem, mum and dad. I hope you enjoy it. But it kind of can't happen anymore because the amount of people who are drawing down pensions is going to be much larger than the taxpayer base can afford. And so the big spending increase that everybody's going on about in the UK has gone from 40% of GDP to 44%, which is actually still in the middle of the pack for the OECD. So it's not like they've gone into huge spending as a percentage of GDP. You should see some of the European countries are far bigger than that. But it is a direction of travel. And so you may, or not being a political, you may or may not agree that taxes in the UK needed to rise to pay for this. But if you don't agree with it, how else do you pay for all this? And so the only way you pay for it is cuts. And the problem is there gets a bit of hang on, I paid my taxes my whole life and I want those pensions and I want it to be triple locked, which means they have a certain amount that'll increase a year no matter what. And so how you demand your triple locked pension increase, but you don't want to be paying higher tax, and you've got an NHS that's broken because it's buckling at the seams because you have more and more treatments needed. That is a really, really, really hard problem to fix. And the way that countries have been fixing it is immigration. Increase your tax base by having immigration. And so what does the UK do? Let's Brexit. Let's stop all those workers coming in to the UK, because you know what? That will solve all our issues. And that caused massive skill set shortages in the NHS, among other places, and a huge issue around free movement of labour, which causing the taxpayer base to not increase much. So then you have to get immigrants from other countries, and then it causes social cohesion issues. It causes everybody's an illegal immigrant, even though the amount of illegal immigrants in the UK is actually really quite small in the scheme of things. And it starts to cause a lot of social anxieties, and it's kind of it's a really difficult problem to solve. But I think so. That's the negative slant. The positive slant is it can be fixed through productivity, because look at the US and how productive they are. Yes, there's issues totally with that country. We'll all agree with that. That's why people like Trump get voted in. But their productivity of their workforce is amazing. And I think when you look at New Zealand, and it's not just their ability to be able to fire people at will and things, it's just the way, and you don't want to perhaps go all the way to the lengths that the US do, because you need worker support and all that sort of thing, and minimum wages, absolutely, and all those things. But just the concept of what does productivity mean, and the big thing is technology, and technology can massively help productivity, and New Zealand needs to be open to that technology, and whether that's through tax credits or those sorts of things to really encourage it, because if you increase your productivity, you can solve a lot of these issues in the NHS and or the New Zealand health system, those sorts of things. So it's a bit of a worrying time, but what I absolutely love about the UK is you walk the streets of London and you read all this and you think, oh my goodness, this is just, the things are tough. And you walk down a street in London and it is fantastic. It is buzzing, there's construction, there's people out doing lots of different things, lunches on the streets, drinking at the pub. I mean, it is still the city that everybody, or not everybody, I love those things that people love. But there's certainly some things that it needs to deal with. And it feels like, whether you agree with the current Labour government or not, the fact that they're making bold decisions is kind of one step in the right direction. And that's kind of, that's my view, not our view. That's my view. And I think making bold decisions, whether you agree with them or not, can sometimes help with the trajectory. And so I think it's, it is a highly educated, smart, bustling, great country with lots of prospects. And why does all that matter? Stocks are really cheap in the UK as well. They pay good dividend yields. They're in lots of different sectors that, if they were the exact same company but listed in the US, would be a lot more expensive. And it's a really interesting hunting ground to look for stocks. But you might not get that catalyst like you do if you're invested in a tech company like the NASDAQ. A great example is a company called Revolut, which is some of you might use it already. It's like a financial services company, started in the UK, and there's a fight between the London Stock Exchange and the NASDAQ on who gets to list it. Now, they kind of want to do it in the UK because, give something back to the community that helped them start. On the other hand, they know if they go to the NASDAQ, they'll be worth a lot more. So, perhaps they'll be worth a lot more. So that's the sort of the fight. But that probably is a great indication of what's going on.
And Europe, you've obviously gone over there a few times in your time. How is it the same level of energy that you're seeing? I mean, obviously Europe's a big place, and there's France and Germany and all the other countries. Where do you see that fitting in terms of growth in the region and as an investor allocating capital to the region?
Yeah, I think there's the biggest worries in Europe at the moment is there's immigration's a big discussion point, and Ukraine. And I didn't really appreciate the worry that European countries had about Ukraine until I got here 18 months ago, because it is on your doorstep, and Ukraine is a buffer zone between, I guess, the West and the East. And that's a really nervous aspect of the Trump regime. I think as soon as Trump was announced here as president, before the German president, chancellor, dissolved parliament, he did fly to France and met with Macron from France to go, we need closer ties here. And because there is a real nervousness that if US does take a step back, and there's lots of arguments why they might and might not, but if they do, Europe really needs to stand shoulder to shoulder, massively increase their defense spending, and really, or do they just let go of Ukraine and lose that buffer? And I don't think they want to do that, but it is a worry because it's awfully expensive to do it, and more money spent on that is less money on the NHS, and you can't do that without a cohesive European Union, and there are some cracks in that. I personally think this is a great time with all this uncertainty for the UK to not re-enter the EU, but to sort of rejoin the customs union, and that might help growth with trade and trade with their biggest trading partners as tariffs in other parts of the world get put on. But you might see with diversity comes more cohesion, and so with that sort of cohesion comes sort of a more stable investment environment. But my view on Europe is it's always hard because it always looks cheap, but without that sort of productivity surge like the US has, I find it really hard to get overly excited about, unless there's sort of one-off companies that look interesting. As a market, it's
cheap for a reason.
Yeah. I think it's interesting looking back through charts. You just see European productivity, probably a bit like ours, has just declined slowly over a long period of time, and that explains why the European market is cheap, whereas the US has fits and starts. Definitely has periods like we're going through now where you see productivity take off, but it's meant they've just had a continual trajectory higher.
Yeah,
it's a compound effect, really.
There's a lot of worry about this US deficit. Well, the whole of Europe's got deficits in different forms. Some of them have got deficits, some of them just got high debt, like Italy. But you know what's a really interesting company this is a total aside country, but Ireland has a surplus of forecasted to be 8 billion. They've got one of the highest GDP per capita in the world. And I think it's because they just took all their medicine in the GFC and now they're bouncing back. Now, it's a tough place because it's extremely high tax and there's a high cost of living issue there. But countries can transform themselves, and they've got a low corporate tax rate, so they get all the tech firms. So there's ways and means to do it. But you have to be bold. And the one thing that I remember, because I worked next to an Irish guy when I first moved back to New Zealand, and his dad lived, this is in 2015, and his dad lived in Ireland, and he was a school principal. And overnight, the Irish government cut their pensions by 20%. Boom, gone. Whatever your pot was, if you had 100 grand in it, you now have 80. Thanks very much. We'll take that back. And they took their medicine, and now look at the country. It's flying.
Yeah, again, this is a very, I don't have any data on this, a very personal view, but I think, maybe that's the yin and the yang of being a small country is you get pushed to points where you have to make those decisions, where places like America or Australia have the luxury of, as you say, the brown gold, and maybe never get pushed to the point where they really have to make those truly difficult decisions.
Well, I was just going to say, in Australia and the US, they're federal systems. So they have states doing different stuff, and you have more of across the net, sort of a wider range of decisions being made, and you get as a total a medium, which is sort of, whereas smaller countries are just one of those states, or the equivalent of.
It's true, because I'd always go on about it, and I'm sure Mark can remember that the actual deficit in New Zealand and the debt to GDP is actually really quite small, but it's in really good shape. But you do have to remember, and this is what the argument back, and it was RAP, it was Dave Wilson that always said to me, but yeah, we're a small island nation in the middle of nowhere, and you cannot run current account deficits and those sorts of things to that extreme, because one earthquake or something can really, really dictate what happens to the country. And that's true. But it also gives you that nimbleness and flexibility. And but it's from an outsider, meaning not absorb living it every day and looking in, you see such a potential of the nimbleness of the country, and it sort of sometimes gets tripped up over itself with ridiculous discussions where actually just some bold moves from, and it doesn't matter which party does it, but just bold moves from the government to just get on with pushing the economy forward, not be so reliant on house prices.
James, it's been a joy to talk to you today. We haven't caught up for a while like this. I thank you for your time, and I hope winter's not too hard in the far north. It's going to be balmy down here. Apparently we're getting 30 degrees tomorrow. So, yeah, I know. Come home. Thank you very much, and we will talk to you again soon in the future.
Thanks, Mark. Thanks, everyone. Really enjoyable. Good to speak.
Great.
Cheers, James.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.